most people's mind is the current environment. We've seen a fairly incredible set of events over the last few weeks as the financial markets have shown extreme volatility. And I was just looking at some of the statistics today. In the last 7 trading days, S&P 500 has declined by 22%. In the last year, in the last 12 months, it has declined 42%. But much more so than the stock markets, there is a severe credit crunch, as we're all aware, and there are fears of this economy of a severe recession. We are, of course, in this setting, not going to solve the country's macroeconomic problems, but what we want to discuss certainly is the impact of all this uncertainty and potential fears of a recession on startups, small businesses, what effect might they have. So let me start with the question to all 3 panelists, and I'll start with Chris. In terms of what effect, Chris, you and the others are having in your own business based on the volatility of recent days, and if there isn't a significant effect yet, what do you anticipate might be things that the company would have to deal with in this particular economic environment?
Sure. So, yeah, we've, being in the software as a service space, we've been at this a couple of years, and I would say in the last 2 months to 3 months, we've seen the biggest impact being, the larger deals we're chasing, the, $500,000 to $1 million type of deals. They're going no decision, they're slowing down, they're getting de-scoped. And it's, people see the value proposition of software as a service, and they see it as a way of reducing costs. But, big ticket items, any discretionary expense, even if it is a cost savings for them in a lot of cases, they're stalling those types of decisions. For us as a business, what will we do to change and modify our behavior? We're getting more conservative. We as a business, we've done 2 rounds of funding. Even though we've been profitable since we started the firm, that money, we've not touched that money, and we're going to really hold on to that in a pretty tight way, and just be a lot more conservative as we grow. We've grown 500% year on year. We're expecting to grow another 300% next year, but the cash becomes king.
Our situation is a little bit different because being a venture capital firm, you don't feel the operational impact of what we do. But I think if I think about what the last 2 weeks has been, the biggest impact is psychological, I think, for a lot of people. And I suspect it's for a lot of people in this room also. Unless you were dependent upon your assets to matter for you for the next year or 2, I think for the most part it will be psychological because we can ride out the storm. But I think the question here is what happens next quarter, because until now, until 2 weeks ago, most people in Silicon Valley, including me, believed that we could be in this bubble where the problems on Wall Street won't spill over and affect our world too deeply. I think the answer is we don't know, but the real impact is going to be on Q4, is going to be on spending. I think a lot of people are going to look at what they need to spend, and I suspect a lot of people are going to look at their costs and think about their cost structure. And I think that impact will happen in Silicon Valley.
I share the opinion with Chris. We are seeing a sort of a slowdown. We are an enterprise software company, so our banks are our customers, other large organizations are our customers. We're definitely seeing a slowdown, but our cost structure is already so highly optimized with a very heavy focus on offshore staff that we're pretty confident that we're going to ride this out. If any company can, we can.
Great. I guess the sort of follow-up question to that, Venki, this is directed to you, I know this is relatively new, the volatility is just a few weeks, even though the trend has been down for a little bit. What are you and your partners telling your portfolio companies in this environment? So, of course, we hear a lot about Sequoia having met with its portfolio companies and so on. At this stage, what are the psychological fears, and then what is the specific advice that you're giving to smaller companies in your portfolios?
Yeah, I mean, you can think about this in probabilistic terms, right? I think there's probably a 75% chance that we're going to have a deep recession. there's probably a 5% chance that this is somewhat of a moderate recession and will come out. And you know, there's probably also a small percentage that this is actually a cataclysmic event. And you know, I just think in the interest of fairness, you want to think about all of those things. And if you think about all of those, you would say, I don't know what the future is. None of us can predict the economy, none of us control it. But what we can control is our burn and our ability to get to be self-sustainable. And so I think, you know, I think one of the big things, I suppose you would add, Chris, is that, yeah, the feeling at so guys, you know, let's get to be cash flow positive. And I think that makes sense even in the best of times. And it definitely makes sense now is if you want to control your destiny as an entrepreneur, or as anyone, if I want to control my destiny as a personal person and my costs are way ahead of my salary, I don't control my destiny. My credit card companies, my financials control it. And I think that's similarly true if you're a startup. And that's always been true. This is not new. I mean, this has always been true from day one. That's why these guys have been profitable, cash flow positive. But I think more so now is that you're going to have a situation where, you know, I think credit and financing can be very hard to get. My wife, you know, she's not in finance economics, and she was asking me, she's a physician, she said, I don't understand what's going on. And I said, the best analogy I could come up with, and I'll try this out, is that just imagine you woke up next day, tomorrow, and you realize that you can't use your credit card anywhere in Palo Alto, or anywhere. You cannot use any credit whatsoever. And you have to pay for everything you do with cash. That is the situation for a lot of big companies in America when commercial paper is not functioning, if they cannot roll over. And just think about what that impact has. You can only do things for which you have cash. And you have to go to your ATM. Maybe you can only withdraw $350 a day, then you're constrained by it. And I think, in a much larger scale, this is what's happening to the economy, is you have these constraints. And until that credit market loosens up, I think we are in for a very tough financing environment, and so control your destiny.
So similar question from a slightly different point of view for you, Chris, and you, which is cash is king. Is of course we get that, and I think this makes a lot of sense. Your response, and then Venki's particular point. Are there other considerations beyond financing that at this stage become important for startups that are already operating? And by that I'm thinking in terms of flexibility around people, trying out certain kinds of models that give people flexibility in the face of uncertainty to be able to move on a dime. There may not be, but beyond financing and beyond cash is king, are there ways in which small companies, or your company in particular, thinks about potentially preparing for a downturn?
Yeah, I would say there's a couple things that that we're doing. One, we've been hiring. We're about a 100-person company, and we're hiring 15 to 20 people a quarter. The hiring pipeline actually is a lot better right now. There's more and more people in the market, and our ability to compete for really good talent, it's a bit of a windfall. So we look at that as a huge positive, and it's something that we're excited about. Changing our messaging, how our go-to-market strategy works. We had been focused in our first couple of years on innovation and driving innovation in software as a service. Today it's about how you can lower your costs by using software as a service-based solutions. The message is pretty simple. A traditional enterprise IT shop spends 4 to 7% of their overall expenses in IT. And moving out all the cloud, we believe you can do it for 2 to 3%. We as a business, we built our whole business, our internal IT infrastructure, we run it for less than 1%. And it's because it's all in the cloud. So we use our own internal infrastructure, our own tools, technologies, and show that to people, that you can run a whole business in the cloud. The technologies that are available to you to start the company on the cheap, they're all out there. And so showing the large enterprise how to do that is that's our business.
So Chris, this is an interesting point, and I think worth following up for this bigger audience, because I think you have an interesting model here that may have some lessons broadly. As you started thinking about the company in its genesis, the point of our panel initially really was primarily focused on how is starting a company very different in today's environment, or has been in the last year and a half, versus what it was 5 to 10 years ago. There's been a whole host of changes. Could you talk a little bit about your experience? You mentioned the cloud, but if you could just talk through some of the operating considerations, and with that, perhaps we can start with the technology component. In what way did you feel starting Aperio was a different experience than the experiences you've had in prior companies, whether they were starting out as larger entities or not? What was differently? What's changed in the technology scenario to make a startup more efficiently doable?
Yeah. Well, I think one of the things that drove us, there were 4 founders of the company. We launched it in August of 2006, and our collective salaries were all working in buildings like this, large enterprise software companies. Our collective salaries were close to $2 million across the 4 of us. So we all went naked, zero, no salary for a year. And so that drives you to spend not every dollar, every penny, very wisely. And so we said, what are the no-cost or super low-cost technology solutions that are out there that will allow us to build an infrastructure that we aren't. It's not going to be a Band-Aid solution. We want to be able to scale and build this thing to a 1,000-person, 10,000-person business. And so, we looked at what are the cloud-based solutions that are out there. Google Apps is a great solution. Why go license Microsoft and Microsoft Exchange and servers to go do something that you can do for $50 per user per year? And that was a great collaboration, email, calendar solution for us. Salesforce for Salesforce automation, Amazon EC2 and their S3 servers for storage and database in the sky, or app server in the sky. So we just said, let's do all the low-cost, open source, SaaS-based solutions, and that's allowed us to build a very scalable model very cheaply.
Well, I know your experiences also.
I think my experience is, although not right now, but historically has been very relevant to a low cost and a cash is king situation. First of all, I think when the job market is bad, a lot more people become entrepreneurs. I know when I started my first company, I was not enjoying my job as a manager, and I just wanted to get out, and I wanted to start my own business, so I, with a friend, started Quality back in 93, 94. If I were enjoying my job, I probably would not have started that company, so that's probably one good thing that you could think about in this environment. The other is, of course, that the cost. Being a self-funded company, the most we could do was take a loan from a bank at times, and that the whole operating mentality revolved around, do we really need to spend here or not? And that, I think, and in some cases, we probably should have spent on things that we didn't initially, but over time we learned. And that has really, really helped the company in the tough times that we've had in the past, and we may have again, to make sure that we always are cash positive.
So Iqbal, this is, in my mind, a very interesting point you make, and I think maybe worth exploring a bit more. Given that you actually did not grow the company by an institutional funding round, you really, the company grew through customer financing and self-financing. Could you tell the audience a little bit more about how that process worked? What were the challenges of it? What did you do to try to make that work? And I'm also particularly interested in the transition towards product, which tends to require greater investments in advance of when the revenue comes. So I think if that would be an interesting point to try to focus on.
Actually, the first company that I started, we were 3 friends, and we did try to get funding, and this is back in '94, so it was pre.com, and all the investors really wanted to be sure that the company had a future, and we couldn't. We struggled for about a year. We couldn't get funding, and that company, we closed it after about 2 years or so. That was a good time to start consulting practice. So a couple of us started taking projects, and that gave us enough extra cash to start to do more and more, and we built the company on a services model. So by the time we actually moved to the product, we were already cash flow positive, so we didn't have to go through funding. The other reason we didn't have to go through funding is because we had a lot of offshore resources, and our team was built already. We had confidence. We had the entire process of how to manage offshore, the expertise, the team, everything was there. So moving to a product company was a pretty seamless thing. It just required the right insight about what is the market need. So that's how it happened for us. I think for those people who are trying to go bootstrap, I think if you can find some services source of income, I think that becomes a very lucrative way to fund something small, and then you can build on that.
Great. Thank you. Returning a bit to the earlier point Chris was making around the video and some of the creative ways in which you really reduce or increase the capital efficiency of a particular model. As you look at the portfolio companies that you're dealing with, or the new companies that are seeking out your funding, how much of a change are you seeing from 5 years ago in terms of people's use of those kinds of creative models? Is it proliferating and virtually everybody is thinking about that, or are there still mostly a hybrid set of activities going on and people still not necessarily being comfortable with utilizing resources that are shared?
Well, I think it's situation specific, right? I think one of the things that's been fantastic about people doing consumer and web 2.0 companies is that they've been able to do a lot with spending very little money. I don't know, when we were an entrepreneur, we bought WebSphere, we bought Oracle, we bought a bunch of things to write our app in. And I think anybody today who does that, frankly, should not be venture funded because they're not thinking about it the right way. You have open source, you have a bunch of things you can do, and so there's a lot of profit you can make. Now, if you're building a chip, sorry. I mean, that doesn't work. You're trying to build the next great solar company and you want to build a solar cell. So I feel like you can't have a one-size-fits-all approach. But there are lots of things you can do depending upon where you are to reduce costs. And I mean, listen, recessions are terrible. That's not your honor. But one of the nice things or the silver linings about a recession is that it really sharpens the focus for a lot of people. And suddenly, those things that were you like, because if you really ask a question, it's really important, it's fundamental, and things drop, and you're able to really focus. I remember at Frigo when we started the company in December '99, funded it in February 2000, so it's still high, and then as the market crashed beyond that, we spent the first venture round like drunken sailors on shore leave, right? I mean, we would go and hire people, and we had people telling us the more people you hire, the more you get acquired for, and we hired a branding firm to name our company. I still remember I spent $300,000 to hire a branding firm to name our company. I mean, we did silly, stupid things because one, we were not experienced enough to know, and we were in an environment where we didn't recognize the value of the dollar. And then when we raised our round in 2001, in August 2001, which was, walking on broken glass, trying to get venture capitalists to give you money, and then we did it. We just did something so different, and the focus, and the results we got out of that was very different. Part of it was that experience of going through it. And a lot of things happen, right? The opportunity cost in recessions changes. That's what leads you to being entrepreneurs, is that if you end up that you're either being laid off or this, your opportunity cost for doing something new is now dramatically different, right? It's either this or staying at home with your wife, which some people might be good. In my case, I don't think it should have kicked me out. So, and so I think that's great. You get people who are committed. You really know who's committed, who's really driven, right? And one of the questions we had at Frigo was we had to do a salary cut. And who was going to take the salary cut, and how did they feel about it? And I think we sort of knew who really believed in the company and the people and who didn't, because that's sort of the rubber meets the road moment. And you're going to find that across every dimension. And so those are, I think, the positive things. And you really get to understand cash flow. I mean, really. That bottled water that you used to drink, go to tap water. Starbucks becomes a once a week event as opposed to once a day. I mean, you just really understand it. And I think those are ways when you make it, and if you make it through to the other end, you really benefit from it. And I think today there's so many ways in which you can cut costs. It amazes me at how efficient you can be. And this is as good of a time as any. And you should do this all the time, but most of us don't have the discipline to do it all the time. But now you don't have a choice. So necessity is the mother of invention.
Great. No, that's probably a good time to take a bit of a pause and see if there are some audience questions. We'd certainly be interested in getting some audience participation and see what may be percolating out there. So if you have a question, please raise your hand. I think we have a small enough room here that, oh, actually Faisal has a mic as well. So if you don't like to yell, then you have electronic aids as well. Go ahead.
So in the last few years, there's some dramatic new undercurrents. Talent is global. SaaS simplifies the channel issues and delivery. And we have open source. If each one of you can...
And you have told a little bit, describe how it has impacted your thought process. And I know you mentioned a couple of those things, but not all of those things. So I'd like to hear a perspective across how those three vectors have impacted your thought process.
So Naeem, just to repeat, you said open source, software as a service, and the global talent pool?
Talent is global. Like teams don't have to be physically in Silicon Valley anymore. Talent is where it is.
Yeah, and I'll start. Obviously, when I was considering leaving my last job as CIO of Portland, my initial thought was I'm going to start a services business around SaaS or open source, and we picked SaaS, and we merged that with the products business, and we said we can incubate SaaS products inside of the successful or healthy services business. But the model that we employed was one where SaaS is a $10 billion market on a $200 billion enterprise software market. We believe that there was an opportunity to leverage a very low cost model for developing products and delivering products and services. A big part of that was the global labor pool. And we have one physical office. We're co-located with Salesforce. Paid very little money for that. We'll never have another office. And we leverage resources like Odesk, like SaaS Coder, or Top Coder. We have every one of our employees works out of their house. We advertise, work with Google, Salesforce from home, travel less. As a result, we put those ads on Craigslist. We have 8,000 resumes that we've seen since we started the company. The global labor pool is super powerful, and we've really leveraged it. So we have resources across the globe that are delivering in the domestic market right now. So it's been a big, big part of our growth model.
So on globalization and global talent, I think the way it impacts VCs is one is, you actually think about investing globally, and I think that's what's happened is people have not only thought about leveraging India, China, Philippines, or Pakistan as a source of talent, but actually go and invest there. And then invest in companies that take advantage of it, and I'll do a plug for one of our portfolio companies, Odesk, which does create a global marketplace. Open source is interesting for me because I think what open source I find pretty exciting about is that there were a bunch of infrastructure players who are putting a tax on development. Basically, if you look at the problem, what happened in the semiconductor business is the EDA tools guys are putting a tax on innovation, right? You want to do a chip, you got to go and get this complicated tools from Metagraphics or Synopsys or Cadence, and it's just a couple of $1 million, $2 million, and that effectively was a tax on you. What open source has done is taken away that tax out. I don't need to get a proprietary app server. I don't need to get a proprietary database. I don't need to do a lot of infrastructure. So that's great because it now lets innovation happen without that tax. And it makes it cheap for someone to build an app. And I think that's the biggest impact in our business is we now think we can build something. SaaS is interesting for me because it's a two-edged sword, frankly. On one level, it, I think, offers a phenomenal customer experience. Software has been plagued by this problem of the shiny software guy who promises you everything on PowerPoint slides, grabs you money, and then delivers code that doesn't work, and software sits on the shelf, right? And SaaS, from a customer standpoint, completely addresses it. You only pay for what you use. If you don't use it, you shut it off. You don't have to have IT. You don't have to have implementation. $50 on a credit card, and you have a high quality, world-class CRM system like Salesforce. This is all goodness, mother than an apple pie for the customer. However, the challenge I see is that it moves the risk all to the startup and to its financiers. Because now you got to say, I got to fund, because it still costs some money, not as much because of open source, to build high quality apps. I've still got to sell it to you, right? I still have a Salesforce I need to go and sell it to you. Even Salesforce.com has it. And somebody needs to fund me. In return, I get predictability and recurring revenue if it really works. But if it doesn't work, then you're going to cancel it. So it moves a lot of risk away from the customer to the financier of these companies and the companies itself. And that's why it's double-edged for me. And we've been trying to think about what it means. Because the capital requirements, unlike if you look at traditional enterprise software models, when they really took off, those companies were very profitable from very early on because you got these big upfront dollars. SaaS companies are not. If you get to the other side, they will be very profitable because they have very good predictability. They don't have to worry about closing 90% of the business in the last 2 days of the quarter and then dealing with 90% discounts. But you need a lot of money to get you to the money.
So I just pile on the stat. I mean, that I think is staggering. SaaS is growing at 4 to 5x the rate of traditional enterprise software, but there's a lot of niche players. There are 1,800 SaaS companies out there that are solving very niche problems. 80% of them are under 10 million in revenue. To Becky's point, getting to escape velocity as a SaaS company is really hard. It's great for the VCs though, because you can put a lot of money to work to make the right bets.
No. Capital efficiency is the single biggest determinant of success and returns for everybody. The best companies in the world take the least amount of money. The more capitalized, the single defining metric in our portfolio of failure is capital raise. The more a company raises capital, the more likely it's going to be a hole in the ground.
This is interesting, and I'm going to go to you in a second. This is an interesting point I think worth emphasizing. For those of you who were here for our summer annual conference, Mike Moritz keynoted one of the sessions, and Mike actually made exactly the same point, which is entrepreneurs see a side of the VCs where when they don't need money, the VCs actually want to stuff them with more. But historically, it is true. At least that was Mike Moritz's point, that his companies that have done by far the best in their entire portfolio have been the least capital consuming companies and have had real capital efficiency. And in fact, named even companies one would think were capital intensive like Cisco, and talked about how efficient they actually were in reality in terms of capital consumption. So, Iqbal, I do want to go on this view, particularly on the global talent pool question, because your company very much operates on an offshore model. So, please.
Yeah, I was going to say we don't use any open source. We are definitely not doing any SaaS. We're the traditional enterprise software, and I do have a personal comment on the open source that we were burnt by open source in our first product. It seems really great until you come into a competition with open source. You come up with a product and suddenly somebody takes that idea and builds an open source alternative. It doesn't look that pretty anymore. It breaks the economic model, in other words. But the talent part, I think the talent has really helped us. I've had an office in Islamabad, Pakistan since 1998, when software was a very unknown thing in Pakistan. You didn't have a lot of activity. In the last about 4 years or so, it's been a booming market in terms of the talent pool that you can get. We have to really struggle hard to keep our employees because there are just so many other opportunities for them. Despite all the bad news that we get in the media, there's a lot of activity happening in Pakistan. And we've actually tried to move, the basic rule that we've had is anything that can be done offshore is going to be done offshore. So it doesn't matter what that is. My head of marketing guy is an expat who moved back to Pakistan for personal, reasons, and he's based in Pakistan. He's costing me a lot less than what he would here, and he's happy because he's getting paid pretty handsomely in Pakistan. So if I didn't have the global talent, we couldn't possibly have developed the products that we did without some serious funding. And so that does enable startups. So it's kind of going to that same thing of the open source where it really benefits companies that are bootstrapped and don't want to spend the money the same way that the global talent really helps the companies get started. That did for us.
Any other questions?
Yeah, from a knowledge worker perspective, given that there are so many SaaS companies out there, how is one to select a good SaaS product to enter, given that you have consulting experience, database backgrounds, writing? How do you know what's a good vehicle for you to get on? Do you utilize your networks? Do you utilize existing skills and your existing talent? Because that can be learned. What is a single, in your opinion, most key factor for a person to enter a business that's going to be lucrative over at least a 2-3 year period?
Are you talking about it as an employee or starting a company as a founder?
Even if whether you're an employee or a contractor or somebody who wants to, take an idea and take it further, I think there may be different answers, but I think initially the question is from a knowledge worker or employee perspective.
I think, employees need to look at it like investors, because you're investing something far more important than an investor. An investor does money. You're investing your time, your life, and your energy. So you're really making a much more important decision. And I would look at, first and fundamentally, you want to join a company that's going to be successful. Because if you join a successful company, good things will follow from it. Successful companies grow, your role grows. When you have that in your resume, there's just lots of things happen when you get on the right train, right? And so first, and even if you don't do much, if you're on that train, you will be fine. And so you better try to pick the right train. And so think of it as an investor. And the question is this company doing something that's innovative? And do they have management that is capable of getting this company to be a successful standalone company? And do they have the vision to do it?
I guess maybe I can respond from if you were to build a company on a SaaS platform, platforms in the cloud, if you ask 10 people, you'll get 12 different answers as to what that really means. But some of the SaaS platforms are evolving. You have Salesforce.com, you have Amazon as a platform, you have Google, their app engine, and everything they're doing on the enterprise side of the business. And they have a lot of kind of boutiques. And then Microsoft's coming in, obviously, flanking with their own cloud-based solutions. My personal opinion on who's going to win that war is whoever wins the developer community. And the developers are kind of jockeying around for where is the talent and where is the best technology. And Google is doing some really interesting things, in my opinion, in this area. So it's but watching to get to real critical mass on what is the platform that's going to win. It takes millions of developers, and these are still in the tens of thousands, maybe 100,000 developers in a couple of these ecosystems. So kind of watching the developer war is going to be fascinating, and it's going to play out over the next 10 years. It's still very early.
But taking that further, companies like Salesforce.com don't have a massive developer base, yet the way I see it, it's probably one of the best entryways at this point for people who want to enter something free. You can play with it for 30 days. You can get experience. Somebody who's starting off fresh, because I get I'm one of the mentors for the Open Mentor program, and I get people asking me, what's a good entry point for me? What's a good vehicle for me to get on right now? So that's sort of my perspective.
Let me make a comment on that as well, because I think Chris gave an answer from a startup perspective to say, hey, how do you want to pick a particular horse from a platform perspective that may be a winner? I think Venki attacked it from the perspective I think you're talking about, which is what market, what application potentially is an interesting, or even a company is interesting for somebody to make a platform for their careers. And I think that's a slightly different question. To me, I think for that, Venki's exactly right. You have to look at it as an investor would, which is how good is the management? how much do you believe in that particular market? How large is it? So some of the very basic questions. I would actually recommend to you an analysis that is the single best analysis I have seen, and that's on the website of venture firm called Bessemer. Because one of the key things about Salesforce, about SaaS companies that Venki points out, is that because a lot of value accrues to the customer, the fact of the matter is that a lot of SaaS companies are spending too much money acquiring customers. They're spending too much money in the sales and marketing costs. So one of the big predictors of how profitable and successful, not necessarily the only predictor, but one of the big predictors is how much gross margin is a software as a service company making for every dollar invested in sales and marketing. I think there's a very interesting analysis that one of the guys at Bessemer has done. I think one of the more creative views of trying to at least identify what the fundamental health of a SaaS business is. So I would just say, look at it as an investor. Look at it as, do you find that the market is attractive? It's big. Is it the people you believe in? And I think those are typically the things that make any company successful. That's the same thing in SaaS.
And what's the name of the venture firm again? You said
Bessemer.
Bessemer. Thank you very much.
The one test I like to use, which I think is true, is you want penicillin, not aspirin. Aspirin solves a headache, penicillin saves your life. And I find the most success, and this is what drives capital efficiency, right? If you have a problem that you're solving that is so acute, people's hands on fire, they will do a lot of things. And the enemy for a startup are time, right? Time's not on your side. You've got to move quickly. And you've got to have someone take a risk on you, because startups are inherently a riskier solution. It's either innovation that may or may not work, a management team that is young, or a financial institution not stable. And when do people do it? When they do it, then they absolutely have to solve that problem. And that, to me, is the biggest determinant of whether you get some kind of escape velocity. Because if it's something they can wait, SAP will do it for you, or SAP sales guy will tell them they'll do it for you.
Wahid, you have a question?
Yeah, actually, I was going to say that, you know what I do if I'm going to start a business? I usually go and talk to customers. If you have a great SaaS idea, go to like 5 or 6 customers and ask them, hey, I have this idea, will you buy it? Actually, just like about a week ago, a guy came to me pitching me a SaaS idea. I went to both my VP of sales and marketing and said, will you buy this? Right? And they said no. Like, it's not that, they said this is a vitamin, it's not a painkiller, In good times we'll buy it, but not in bad times. Anyhow, so that would be my advice on that. Venki, I have a question for you. You are the man in the spotlight today. The last one, people have been asking me this question, and I don't know why people think I'm a VC. I'm not. I'm just an entrepreneur. It's about, what's happening in the markets, right? So the federal government is coming to the rescue of the banks and doing all kinds of stuff. In the Silicon Valley, we have a very interesting ecosystem of the entrepreneurs and the VCs, right? Because without the other, the whole ecosystem dies. Valley is destroyed, right? So VCs, their money gets committed in 7-8 year chunks, right? So your fund, probably you guys raised money 2-3 years ago, right? And you're going to return back to, to your LPs in like 6-7 years, correct?
10 years.
10 years, exactly. So why should VCs be so concerned about what's happening today? Because they have such a broad horizon. So why don't you guys, just like the Fed gets up and says, our doors are open, why don't you get up and say, what, we are investing in good ideas and kind of like take the risk out of at least Silicon Valley.
I got my wallet open, buddy.
No, I mean, this is a serious issue. I mean, everybody I talk to is asking this question, what are the VCs doing? What are the VCs doing? So can you kind of like shed some light on it? Maybe also have your friendly VCs that you talk to, maybe continue the investment in good businesses. I'm not talking about.
No.
So give us some light on that. Shed some light on that.
Okay. The first thing is, yes, structurally we are set up to be 10-year funds. So people give us, they make a capital commitment that they say whenever you want, we'll give you the money. And whenever we make an investment, we ask them to give us the money. And then they expect to get it back, right? I mean, they would like us to give it back to them much sooner, but they give us 10 years. So that's the timing. But the issue that I think is here is that the venture capital industry in the last 7-8 years hasn't been returning capital. That is an issue. That is a fundamental issue for the venture capital. Independent of this burst of a credit bubble, the last 8 years, venture capital has not been a positive asset class.
Let me give you some numbers. Roughly, venture capitalists raise every year around $20 billion. So I'm going to give you a rough number, so it's easy to do the math, right? So if you think about it in one way, in the last 8 years, venture capitalists have raised around $160 billion. Now let's think about the exits. And you got to do an important number here. You got to do number with Google and number without Google. Let's do the number with Google. The number with Google is that total venture-backed exits period is around $140 billion. Okay. Now, that $140 billion is total venture-backed exits. Venture capitalists on average own 50 to 60% of the company. So they would have probably gotten out $70 to $80 billion. So 8 years, put $160 billion to make to work, $80 billion to get. Now, it's not bad as Marvel stock, but it's definitely not something you want to get 50 cents on the dollar on. Worse, take out Google, which is $110 billion of that. Venture capitalists only return, and there are only two firms, Binance, Sequoia, and Google. And the venture capitalists return only $30 billion out of 160. Now, that's getting closer to Marvel. Still not zero, but it's getting there. Now, tell me, if I went to you and said, give me some money, maybe I'll return to you 50 cents on the dollar in 8 years, but most probably it's going to be 20 cents on the dollar. How many of you guys are lining up to give me some money right now? That is the problem. Until the exit markets, which is really the IPO markets, open up, venture capital in Silicon Valley is under risk. And to be honest, a lot of LPs and institutions have been giving on this notion, venture capital and innovation is kind of sexy, that it feels a lot better to say that. And so there's been a lot of capital being invested with this notion that at some point it'll open up. Well, with what has happened now, that window has been pushed back. So nobody is going to be going around with an open wallet, my friend. It's gone back to, but by the way, this is not bad news. The best companies in America, some of the best companies, but never venture back. They were formed by people doing entrepreneurship the old-fashioned way. And a lot of venture capitalists are terrible. Some would say even me. Most often they destroy companies as often as they create them. So this is, the best, you look at some of the companies that have stood the test of time, the good to great companies. Kimberly-Clark, General Electric, Godam, Gillette. These guys didn't bring venture capital to start, need venture capital to start their companies. They created and built great sustainable companies without venture capital. So this notion that venture capital is necessary is wrong. It actually could be wrong. It could be evil in some senses because venture capitalists tend to accelerate businesses much earlier than that might be appropriate because they need to make a return characteristic. That's different. So there are lots of ways in which some businesses are not good fits. And so you need to think about the business you're trying to build. And are you building a hamburger company, build to flip? Or you really want to build something phenomenal and great? And you decide that, and then you figure out what is the least dilutive way of financing it. But right now, venture capital also has got structural issues. That's why you're not going to see a lot of people open their wallet, ready to invest tomorrow. And frankly, if the Fed wants to do a bailout, I'm ready.
Are there any other questions? There are several questions.
When you guys were starting out, did you guys do anything particular to reduce the sales cost? Because as a SaaS company, sales cost is kind of prohibitive. You guys do anything in particular to keep the sales cost down as well as channel marketing or channel sales or anything of that stuff?
Yeah, again, we are a hybrid model. So our first year was all services-based business. So we jumped out of the market. We bootstrapped the company for 15 months, and we created about $2.5 million in profitable services revenue in our first year. And at that point, we had a couple dozen very good customers that were getting good cash from, gave us a petri dish to launch our products. And we had a very small sales staff. It was basically the founders in the first year. And so we did everything. We sold, we built a company, we delivered the projects, and we wrote the products at the same time. And the products we used, we got in the market for really marketing. It was viral-based marketing. Instead of spending money on marketing, we said we're going to spend marketing dollars building products to get out there. We're just under 100 people. We have one person in marketing. We keep our cost of sales and marketing is pretty low because our business, again, is a hybrid business. It's services that are driving our product strategy. The capital that we've taken, we took some from some angels, from Salesforce, and from Sequoia, is designed to fuel our product business. We run a very healthy services business, and the capital is designed to fuel the products, but we've still not touched it. We've not touched that capital, and I tell you, we're probably not going to touch it for a little while still.
One statement on sales cost for SaaS companies is that, and this is, I think, very important. I find that sometimes I get technical entrepreneurs coming in and they say the product is ready. They say, oh, I want to get a VP of sales. I'm like, no. A VP of sales is a kind, operated guy who you will, if you tell him exactly what he needs to do, he can maybe execute it. He will charge you 3 times as much as someone good, and you probably get 1/3 the productivity of someone. And what you need to do, if you're a startup, you need to be, the founding team needs to have someone, or need to be, they're going to go and sell the product themselves. And I would not hire a sales guy until you sell 10 customers by yourself. And if you say you need to hire a sales guy to do it, then you're thinking about it wrong. Because if the founding team cannot sell the product, no sales guy can. You need sales guy to scale your product, but you need to go out and sell it. And then at the end of the day, most companies make a mistake of hiring salespeople before they're furthest along the sales learning curve. And I really recommend, if you're in software, look up the sales learning curve by Mark Leslie, because that gives you a really good sense of both where people go wrong with software companies and how you can do it right.
So I heard earlier that SaaS is a double-edged sword, but I'm hearing now that sales costs and the marketing costs, or viral marketing, can be significantly lower. And so I don't understand why there's concern about capital efficiency of SaaS companies. So maybe you could explain further.
Well, I think Chris started off with a services model, right? He was able to get a lot of traction and use the services model and the services plans to sell products into. Which is, I think, a little different from most SaaS companies who build a product and then go and sell it. Right? I think his model is the traditional way you do it to bootstrap your company.
Yeah, I mean, we believe that SaaS creates a fundamentally different model. In enterprise software, the historical model has been raise some money or go spend a year or two to go build a product, launch it into the market as a 1.0 product, and then you have to wrap a bunch of services around it to make it 2.0. We said, let's flip the model. Let's build a very healthy services business. Let's figure out what the market needs. Let's make sure it's really profitable, and then we'll incubate products as a result of that. And so our model is a little bit unique. And over time, we believe there's 3 parts of our model. There's a services model that'll be probably 40% of our revenue. 30% of our revenue will come from products. And we believe there's a third model we call cloud sourcing, which is ratable services, which is basically billing companies on a recurring basis to move their entire IT stack to the cloud, giving them guaranteed service levels for that.
And how do you handle pricing if the capital efficiency is concerned with these different models?
I mean, we have basically 3 different models. I mean, we have a project-based pricing model. We charge time and materials, so a straight-up consulting business. And we've actually been able to increase our prices every quarter since we started the company. We've had a great talent pool, and we've been able to raise our brand, and we raise our prices alongside that. Our products business is very different. We have some products we sell on a monthly recurring basis for pennies on the dollar, others that are more kind of enterprise products that we sell again on a monthly recurring basis. And we price those, we look at those as individual products that we sell in the market. And so it's really 2 different pricing models.
I think there was a question there. Thank you.
I have a question for all the panelists. I'm wondering, if you were starting out and you were pre-financing, how much money would you expect to spend on development? I know it's a broad question, and really depends also on the product, but I mean, sort of, what is your gut feel for that?
If you're doing something offshore, I can talk about Pakistan. I don't know about other countries' cost. You're going to probably start out with a 5 or 10 people team to do your development work. You could probably get all of that done in a $100,000 to $200,000 as start cost, and take the product to a stage where it's a beta version is done, and then you got to get a couple of customers lined up, and then once you have those customers, then it starts to move on its own. But I think you should, not including your own cost, just the offshore cost, about a couple $100,000.
I mean, I would say though that I think this question is really heavily dependent upon the nature of stuff that you're really trying to do, because if it is a consumer-oriented business, a Web 2.0 oriented business, that has a completely different implication versus if you're building any kind of a product for the enterprise market, which has a completely different kind of characteristics. So I think that's a great benchmark even for an enterprise product, which I would say that's probably one of the most capital efficient ways of doing it. But obviously offshore has other issues which everybody can talk about, where, really proximity to the market, knowing the market and all that kind of stuff is critical. So you can't just use offshore off the shelf.
So one of my strongly held beliefs are that great things can only be done by a small group of people. And so, I am inherently skeptical that a large group of people can do it. So I'm like, to me, great products start out with 2, 3, 4 fantastic people doing it, and maybe you then add it with overseas talent. And so I think you can do a lot for sub $200,000 if you have the right team and the right focus, right? And frankly, you're not going to do something great by law.
Yeah, I mean, in our world, when we started the company, again, it's a bit of a hybrid model, but we the 4 founders put $100,000 into the company, and we just said, how much do we want to spend on our first product? We were a services-based company, and we knew we had a certain burn, but we spent $6,000, and it was a way of proving that we could connect in the clouds. We wanted to connect the iGoogle homepage to Salesforce.com. So it was a collection of Google gadgets. Very simple. My co-founder Marinder was the architect, the designer, the core developer, but it was backed up by a couple of guys in India. And we got it used by over 1,000 companies in a 4-week period of time. So we spent $6,000. That was our model. And then, we didn't make any money off that. We got a lot of brand awareness that, hey, these guys are innovative and they're connecting the cloud, which was the intent of the product.
Yeah, I think I probably did not elaborate. You got to have one senior technical person here who understands the technology, who understands the actual problem that you're trying to solve, and the offshore is only to multiply the effort. At the minimum, you need one senior technical person here, and of course, if you're doing a product, you got to also have a marketing.
But I completely agree. Thank you. I mean, you got to get the black belts. Small teams. It's not engineering by the pound. We have a product we're releasing right now that's a connection between Salesforce and Facebook. It's a very cool app. It's going to get viral very fast. It's half of one guy for 2 months. It's just a different world.
There's a question after here first, we'll go back. Is it right?
Thank you. Speaking of Web 2.0 and monetization, would you today absolutely insist that it's the Web 2.0 startup that generates revenues, even with few registered users, as compared to generating a lot of eyeballs that would eventually be monetized?
I think for me the most important metric on a Web 2.0 company is engagement, right? I think when you do acquire a user, are they engaged? How deeply are they engaged? What are the things they do to show their degree of engagement, right? You have Facebook and someone says this is the thing I can't live without. I can live without my cell phone, but I can't live got my Facebook page, I check it first thing in the morning, spend 2 hours a day on it, that's engagement, okay? And so if you have engagement and you can acquire users either virally or fast without spending any money, so you're acquiring users without spending any money, then that is the trifecta. Then the monetization risk venture capitalists will take. And the more you can show engagement and acquisition, before you, the more compelling they are, the easier it's going to be. Right? In an ideal world, it would be a highly engaged service that is viral and creates network effects. That is the trifecta of things to look for. If you do all of that, you can eventually monetize it. Or even if you don't monetize it, there's enough value there that somebody will acquire.
I have a question before Mr. Iqbal for the development. You mentioned earlier that you got to have somebody here in the valley. So as the workforce is becoming more global, aren't the markets also opening up? There has been a lot of discussion on the software side, but I know for the hardware side, for example, that in China and India, now there are companies coming up which are totally taking the market on their own. So they are running sales and marketing operations out of India. I'm talking about the hardware. I don't have so much knowledge of the software side, but there are chip companies now starting in China and India, which are just completely taking their own read on the market and going after the international market rather than relying on the Silicon Valley. So I would like to ask the panelists what their views are. How long do you think that we need a strong foothold in the valley, or is there a time that we got to, break loose that part as well?
My opinion is it all depends on who's in the company, what is their exposure. The reason I mentioned a person here is assuming that if you go with a typical offshore, the team offshore is just talented engineers, they don't understand the market, so they may solve the wrong problem. If you're only a non-technical person, you may not be able to explain the problem to them, so there's a disconnect. So there's no substitute for having a technical person here who truly understands what you're trying to do. Now, if that person doesn't have to be here, it could be somebody in Pakistan or India or China who understands the problem. But the question is, what is that person's background? That's the main thing. And I think you need to have a senior person who has seen the problem that you're trying to solve.
So here's my framework. You have customers, you have employees, you have finance, your investors. You got to be where two of the three are. So if your customers are in India and your employees are in India, you can be there and you can have your investors here. Ideally, you like all three of three, but you need two of the three. If you can't get two of the three, then you can't be there.
I would agree. I think the one point that has been interesting to us is that you can do anything with your global workforce. And one of the things we're working on right now is a lot more value analysis. McKinsey-like analysis that's happening out of a firm in India. And it's very powerful, very cost-effective. In the past, it'd be like, hey, I gotta hire a bunch of smart guys in the Bay Area to go do that because all my customers are right here. And we're getting that very high quality type of analysis done, all behind the curtain.
Actually, I'm exploring startup right now, so I have many questions. So I'll lay down. So first question is, you already explained that engagement is the key. First question is, how many you would see where you would say, okay, I'm ready to invest millions of dollars in this startup. So that's first question. Second, I can ask all questions at the same time. Second question is, there are three models. Like one is the long tail model. Wait a couple of years, and then you start seeing advertisement money come. Second is you have consumer base, something like Netflix. You have $10, $15 range, people can afford it. Third is of course enterprise as well. So what is the impact of economy on these three models? So that's third. And last question, sorry. So last question is like if you are really starting up, what is the right mix? Like you mentioned salesperson in the founding team, and probably your team already has a salesperson. Like what is the right mix? If more engineers start a company, is it good enough? Or what will you see in the founding team that you will be willing to invest?
maybe that would maybe the best way to
Yeah,
remember.
so that might be let's start with the team, and so I think if you're doing, looks like you're trying to think about a consumer internet startup, right? I think in that case, really, sales is not the issue. It's really to me product and marketing. So you need to have really good engineering and product people, because ultimately, in a consumer internet startup, your product is your sales tool, right? If it's a compelling service, people come in, they're either going to use it, and then they're going to widely spread it. And if it's not, it's not. So you need great product, great marketing. Your second question was, are you better off long tail, Netflix-like subscription, or enterprise, and how does the economy affect it? Enterprise is the hardest to do, because anytime you need to go and get a check, I'm loud enough, I don't need a matchup. Usually, enterprise is the hardest to do because you need to go and get a check from somebody. That's always hard. So I think that gets affected the most in the economy, because anytime you got to ask somebody else to do something, that always slows things down. I think subscriptions are easier if you have a really compelling service, though. I mean, the problem with subscriptions is that you need to have an extremely compelling service for someone to whip out a credit card and put it in on a monthly basis. So you got to decide if it is. So most likely, I think it's going to be long tail of the three. And I think your first question is I wasn't sure if you meant number of people in terms of engagement, or how you define engagement.
No, when you start seeing the advertisement as a revenue source, how many millions of users will you see engaged in that?
So you need 5 million uniques before you can actually. So there's a couple of things you want to think about. If you want to get an RFP from advertisers, the minimum cutoff of 5 million uniques, most likely you need to have 10 million uniques. And the other question you need is if you don't show up on ComScore, none of the big advertisers will use you, because nobody trusts anybody's numbers. So ComScore is terrible, but unfortunately they've gotten into the position of being the one that people believe. And so you need to be on the ComScore. And ComScore again is not going to track you unless you're close to 10 million uniques. And so that's the problem. It's very hard for me to see how a bootstrap company can get to 10 million uniques all by yourself. What you can do is you can get to 1 million uniques by yourself. And then you can take that to venture guys and show, here's my 1 million uniques, I haven't spent any money to acquire them, and these people love it. What is your 7-day actives? That is my question. How many people come back in 7 days and use it, and how long do they spend on it? If your 7-day active numbers are high, and people are coming back, and you're showing your growth rate, then you can get some money to get you to 10 million uniques, and then the advertising model opens up.
Okay, last question from the audience, and because I want to leave a little bit of time for folks to network, and we are approaching 8:30, so you have the last question from the audience.
Yeah. So are there going to be any markets that are potentially recession-proof? For example, if you're struggling in Silicon Valley, is it a good idea to go to the Middle East or Japan? This is a question for Venki.
So I was talking to a bunch of people, and we were trying to see, are there any truly, counter-cyclical markets? Best thing I could come up was Brico Man, start a franchise of Brico Man. Seems like that should be counter-cyclical, or fixing up foreclosure houses. I think this is what is happening right now is a very global phenomenon. So I don't think you can escape the impacts of it by going to different geographies. But I think different geographies are going to recover in different paces. And I feel that the Asian economies are going to recover much faster than the European and American economies for a variety of reasons. So I'll try to I think if you're looking that way, either try to take an economy that's sufficiently insular, so it's not as tied to the global. So 70% of India's economies, so you want to look at non-export driven economies. China's a very export driven economy. India, I'm not sure about Pakistan, they tend to be less export driven economies. And there might be countries in the Middle East that are less export driven. Those are going to have a better chance of success.
Great, so let me ask the last question to the panel before we wrap up here. And this is a question that is really about anybody in the audience who is, and I think there's been a few questions of this tenor, which is anybody who's thinking about starting a new company in this environment or thinking about joining a startup. Starting with Chris and then going down the line, what are the top 3 things that you would ask them to consider to make sure that that's there? I know there's 1,000 considerations, But what are the, in terms of priority, the top three you would say, make sure you think through X, Y, and Z?
I would say, I think that the formula is pretty simple in my personal opinion. Thousands of business books written, I boil it down to, pick a really big market that has high growth rates and spend a lot of time, over-invest in putting your team together. The team that you have, the roles you put them in, and how you motivate them, in my opinion, is the number. If you're in a big market that's growing fast, over-invest in hiring a team. One of the things that we've employed as a company is, we put people through a very, very long interview process. And across the 4 founders, we have a unanimous agreement on every single hire that comes into the company. We interview every single person, and we've agreed on doing that up to 200 people. And it takes a long time getting through. And our schedules are worse and worse every single day. But investing in the team and making sure like every person that you hire is like that. It's like hiring the first person in a company because it's the DNA of the company forever.
I guess my first criteria is, are you a missionary or a mercenary? So missionaries go up and they try to convert people with no pay, living in terrible conditions. Mercenaries try to fight other people's wars for money. And I think that's really important because you got to decide. Because I think startups and being an entrepreneur, the journey has to be its own reward first and foremost. And if you're a missionary, the journey is its own reward. And then if you get to the right place, fantastic. But if you're doing it with the goal of a pure goal, everybody needs to make a financial windfall at the end. But if your only goal is that, I'm not sure that's motivation enough for the hard times. And so that's my first criteria. Make sure you are a missionary, or pick something that you're really passionate about, because that's how you'll be a missionary about it. And the trust is, will you do it even if you don't make any money, if it's going to fail? And you've got to answer that question, yes. And I think if you do that, then surround yourself with people like that, and find a problem that's sensible.
My opinion is, if you're going to do a startup, have at least 2 of you. One person who's a technology person, and the other was a business person. That could be marketing, it could be sales, just a person who can understand the customers. And as Wahid said, if you can talk to a few customers, potential customers, to get the idea validated, that would save you a lot of headache down the road.
Just one other thing I would add. If you're going to go into business with a partner, or more than one, 2 or 3, sometimes it's 4 buddies, agree very early on how you're going to make decisions and write it down. Because inevitably when you start, it's all rosy, it's all cool, everything's great, you're loving life, hard decisions come up, and you have to figure out how the tiebreakers happen.
Just one other quick comment if you're looking is the law firms around here, they'll defer fees up to $15,000, $20,000, and then that'll come out when you raise your Series A. So talk to the lawyers because they will work with you, and you get a lot of really good legal advice. All the fees are deferred. FINRA does that, DLA does that, etc. So that's another advice. Get a really good lawyer early on because similar to when you start with the 2, make sure you guys both agree on how the cap table is going to be, so that you don't have an issue if one partner decides to leave 6 months into it, and all of a sudden you're not best friends anymore. So that's really critical early on too.
And they make that money back.
Yeah. Great, thank you. Well, thank you very much to our panelists. Thanks, Chris. Thanks, Venki. Thanks, Iqbal. This was an engrossing panel. I hope the audience enjoyed it as much as I did, and great questions from the audience.
It's incredible.
Thanks very much.
Yeah,
How are you?
How you doing?
Wonderful. How are you? I'm glad. Good to see you.
Yeah, it's a good program, man.
I'm so glad you came. Yeah. They have amazing programs here and
Yeah.
elsewhere, you know? Yeah.